Okay, so hey everyone, thank you for joining the webinar on today on navigating a rising interest rate environment. Um, we're going to share with you some brief topics, won't take up too much of your time, 15-minute presentation, and just outline some ideas about current state of the market, how we've got there, and where we're going in the future, and how you can benefit from some of the strategies that I'm seeing within a lot of my clients and their portfolios going forward. So wanted to jump right into that for you here. So what we'll cover in this webinar is an overview of where we are today. We'll discuss cap rates and interest rates and the relationship between that, as well as give you an idea of where the market is today and where I anticipate it going forward. As well as we'll then discuss specifically on what your game plan is and how you can effectively take advantage of the opportunities available in this market and how to position yourself to best succeed. So where we are today, pretty much what we want to do is wind back the clock to 2021. We saw all-time low in interest rate environments in Canada, and pretty much throughout the world. Coming out of the pandemic, the central banks around the world reduced interest rates to spur demand and business. And what we found is that, or what they had said is that they anticipate keeping interest rates low for the foreseeable future. What we started to notice into 2020, into late 2021, was that the inflation rate was starting to increase, and as a result, got the Bank of Canada quite concerned with seeing if that they may have overstimulated the economy. And as a result, they raised interest rates 7 times throughout the year of 2022. So we essentially went from 0.5% or 0% all the way to roughly about 4.5% where we are today. And I mean, and if you calculate what they just raised rates in January, another up to 4.5%. Another up to 4.5%, we can calculate up to about 8 interest rates hikes we've had really over the last year. Now, most recently in March, they have changed their tune and have put a pause on it, seeing that they are seeing inflation numbers starting to reflect or starting to go down. And they feel that they may have reached a point where they don't need to raise anymore. But what they have said as a caveat is that they're going to be data dependent on how things turn out. So that will affect what they're going to do going forward. Now, what that has done to the market per se, and how that relates to the commercial real estate market, is what we've seen is essentially a pause in the entire market. We've saw sales, depending on the asset class, drop anywhere from 20 to 30%, and values, interesting enough, have maintained over that time period. We're starting to see on some sort of residential land development opportunities, some of those have actually started to decrease, just because the residential sale values, the residential resale values of homes have been starting to be affected, and that affects what builders can then pay for land going forward. So what is interesting is that we've noticed is that the spread between the spread between what buyers are willing to pay and what the sellers' expectations are has remained far, and that's what's really reduced the amount of transactions that we've seen. So interesting enough, sale prices haven't decreased at all, or very minimally, and we're starting to see as sellers start to hold back from the inventory which is available. Now, what I'd like to share with you in this chart here is that over the last 20 years, and I have a similar chart for retail as well as industrial properties, but what we've noticed is that there's been a cap rate compression over the last 20 years. And typically what we've found is the relationship between the prime rate or interest rate and the cap rate, there's usually about a 2% delta or 2% difference. And that's really the spread where investors make their money. What we're finding now, and what's interesting, is that the cap rate is still compressing, and we're actually getting in somewhat into negative territory in terms of the spread between the cap rate and interest rate. What that ultimately means is that we're finding that, but even though interest rates have increased, cap rates haven't increased to compensate that. And what that shares is that investors are willing to take a lower and lower return in order to position themselves in the particular asset classes within the GTA and the Golden Horseshoe. And what I'm finding overall is that because there's a lack of supply of opportunities available in the market, that's what's key, and we have such a strong demand from investors, that's what's keeping pricing and everything stable going forward. If we look at the industrial market, we're seeing something of the similar nature, even in sometimes into negative territory in terms of the spread. Again, same reason, there's not enough opportunities available, and as a result, buyers, in order to get into the market, have to pay the prices based on the availability. Now, what we're also seeing and speaking with a lot of investors is that they're looking at their alternative options that they have to purchase, and the long-term stability of the GTA market is proving quite strong, as well as a reason for them to put their money into such low return investments in comparison to what they would get, let's say, in the stock market or any other equities where there's a lot of market fluctuation and uncertainty that they're finding. So as for the time being, I'm not sure how long this will last, but as for the time being, we're seeing market pricing is stabilizing. Now, one caveat that I will mention is that cap rates are a lagging indicator. So interest rates can increase quite quickly over a short period, but cap rates are, and the logging of the cap rate numbers is determined by sales transactions. So it's typically takes anywhere from 12 to 18 months really for us to start to see cap rates tick up or change. And it's yet to be seen how long we're going to keep these interest rates at these levels in order to determine, whether that's still going to continue. So I guess the first question now, as it relates into your properties, is what's your game plan, right? How is this going to affect your property, and how can you move forward in this sort of environment? What I like to work with clients on initially is discuss with them what their initial game plan was when they purchased their property. As we navigate through this environment, it gets increasingly challenging. So it's best to start back at the original standpoint as to what our purpose was when we purchased our properties, or what was our overall goal with our portfolio, so that we can then start to make decisions going forward on how to best approach things. And some examples of that were, maybe when we purchased the property, our goal was to reposition it by increasing interest rates or increasing rental rates. Maybe we're going to add more square footage to the building, or fill some vacancy to value add and increase some of the income on the property. So what I like to look back at is, what is your initial game plan for when you purchase the property? And then next is, how is it currently performing today? Have we achieved a lot of those goals? Are we going in that direction? Or are there some things that we need to change going forward in order to make this possible? Really, the whole idea is to get an idea of what our current investment returns are today and what we're generating on the property. Have they met our expectations? Do we have the right people in our right team members in place to execute on our goals? And that will give us an idea as to how we can make decisions going forward. And then it leads to really our ultimate goal, is that what is our exit strategy for this investment? Do we plan on keeping the property forever and giving it to our kids, or do we plan on selling it once we achieve a certain number or valuation, or hit a specific age or return on investment that we've done? The reasons don't really matter, but it's important for us to understand what we're trying to get out of this investment, so that we can make decisions on what to do going forward to meet our end goal. So that leads into ideas around, okay, well, how do we mitigate this impact of this investments, and how do we deal with these rising interest rates and what we're seeing currently in the market right now? First thing I like to look at and kind of reframe your perspective on it is that interest rates or to look at interest rates just like any other expenses, similar to property taxes, similar to insurance or any maintenance on the property. These are some of a lot of the times we don't control whether they're going to increase or not over the time. But if we can plug them into any sort of investment pro forma or analysis and treat them as such, then we can best manage our investments going forward. What I also want you to look at is let's focus on things that we can actually control. And what are the things that we can actually control in the grand scheme of things that are going to improve our investments and our overall returns? So some things to think about, and what's been effective with a lot of our clients right now, right off the bat, is raising rents on their existing tenant leases or leases that are coming up for renewal. This is an obvious answer, but what we're finding is that the rental rates have increased significantly if you're speaking about industrial or even retail rates from 5 years ago when maybe you signed the lease. And it's best to get an understanding of or what's the current market rate for our particular unit, and how can we get those rental rent numbers up there. The best thing to do is increase our income on our property, increase our net income, and this is one of the ways in which we can do so. The next thing to consider and look at is, can we add square footage to the building? If it's an industrial building, can we expand it? If it's a retail plaza, can we add a pad and release this space? Any way we can add additional income sources or income generating sources from the property can help our bottom line going forward. As well as maybe on what I'm finding with a lot of owners too is charging for pylon signage, simple ways in which they can get monthly revenue to that help offset a lot of the expense increases that they're seeing through interest rates or other maintenance things that they're dealing with. Another simple strategy, what we're finding, is filling current vacancies. The easiest way to improve our operating income is in twofold. When you have a vacancy on a property, not only do you lose the net income that you would have generated, but you're also paying for the TMI costs for that vacancy. So the quicker we can fill that vacancy, the quicker we can hit numbers or increase our income and increase our net income at the bottom line. Now, I know I'm talking a lot about net income and increasing our numbers on that, and the reason being is, for majority of income properties or properties, the values are derived from the net income generated on the property. So if we can increase rents and reduce expenses, the larger the net income is, the better the improvement in value we're going to get when we multiply it on a cap rate basis. So that's what I'm focusing on, and that's something where it's most in your control and what you can focus on trying to increase and generate. Obviously, on the other end, I know I talked about income, but let's talk about the expenses and what you can do in terms of reducing expenses. And that comes from renegotiating with a lot of your vendors, whether it's individuals, snow plowing, landscaping, your HVAC guys. These sort of things can help reduce some of the expenses on your property, and then ultimately boost the net income. The other thing we can look at, and this is obvious too as well as we get into things, is obviously paying down existing debt. For the longest time, we were in such a low interest rate environment, it made sense to hold debt on our property because we were getting cheap money. It may make sense today to pay down some of that debt so that we can weather this current storm where we're in. Many investors I'm talking with right now are anticipating that towards the end of this year or into 2024, we may see a reduction in interest rates. So if we can get through this period, if your mortgage is up for renewals or coming due, maybe it makes sense to pay down some debt in order to do so. The obvious other ways or strategies is obviously shopping around with your for your best mortgage rates, and trying different lenders, different alternative options that may be available. That way you can better manage your debt load currently right now. What we're also finding, because owners or a lot of investors I'm talking are anticipating rates reducing over the next 12-18 months, is they're signing on to shorter loans that have maybe a 1 or 2 year term, that when they renew in the future, they're going to renew into a lower interest rate environment, and they can then better position their properties during the interim and maintain their staying power throughout this period. So the whole goal is really to have a further outlook on how we're going to approach things, and then make better decisions based on that information. For my feeling overall is that I think the era of low interest rates is gone, and I think it may be actually healthy that our rates stay at these elevated levels. And when I say elevated, anywhere between 4-5% range, I think is where it's going to be for an extended period of time. We may see dips in the rates depending if we go into a recession or other external factors that may affect things, but this may be maybe this is what we can expect as really the new normal going forward. So this was just a brief presentation on it. What I just wanted to share with everyone was just to give you a brief an idea of different perspectives and ways in which individuals are approaching the market today. Obviously, the devil's in the details as it relates to your property specifically, and really tailor making an approach directly towards your assets. What I encourage obviously is to reach out to me through email or phone if you want to have a better discussion as it relates to your particular situation and your properties, and I can give you a little bit more insight than that, but wanted to give you kind of a broader overview of where we are in the market and where I see things coming forward. If you'd like a copy of this presentation and the slides, which you can do, just reach out to me. I can send you an email with a copy of it, as well as a replay for this video if you wanted to watch it later, or for those of you that have missed it, it will be made available to you and will be emailed to you directly so that you can rewatch with it. And what I'll be doing going forward is creating future webinars similar to this on different topics that investors, owners are experiencing, as well as market activity and how you can best position yourself going forward in this somewhat turbulent times, and wanted to share this information with you. Also, what I'm open to hearing is some of the topics or information that you would like to hear that would be most valuable to you, and topics that you'd like me to speak on, and to help you give you some more insight on it. So wanted to share that with you. If there's any other questions or anything else, you can always let me know. But just wanted to keep this short for you guys, and look forward to connecting with you in the future. Thanks.